Hey everyone, and welcome to today's Explainer. Look, today we're going on a bit of a hero's journey, but our protagonist isn't a person. Nope, it's a single glowing 3D dollar bill. We're going to track exactly how this $1 navigates the wild, complex financial universe. We'll follow it right from the starting line of basic budgeting, watch it battle the absolute villain that is high-interest debt, see it deployed into the stock market to multiply, and then watch it get supercharged by Wall Street's cutting-edge AI. Finally, we'll look at how to shield it when entire systemic financial structures just collapse. It's an incredible journey.
Okay, let's dive into this, because here is the core question we really need to answer today. How can fundamentally shifting your approach to just a single dollar radically alter your future? You see, most of us just look at a dollar as a tool for consumption, right? You trade it for a coffee or a bus fare and it's gone. But when you look at the data, a dollar is actually a seed. Depending on where you plant it, it can drag you down, grow steadily over decades, or literally be wiped out by global market forces.
To get a handle on this, we're following a clear roadmap today. Number 1, your financial starting line. 2, escaping the debt trap. 3, deploying your first dollar. 4, the algorithmic edge. And finally 5, surviving financial collapses.
Let's start right at the beginning. Section 1, your financial starting line.
Before making any real progress, you have to know where your very first dollar actually lives. And that brings us to the absolute fundamental rule of accounting, the golden equation. Whether you're running a massive multinational corporation or just managing your own wallet, your financial health comes down to this simple formula. Assets equals liabilities plus equity. Assets are what you own, so cash, property, investments. Liabilities are what you owe, loans, unpaid bills. And equity, or your net worth, is what truly belongs to you after all those debts are settled. So the big takeaway here, every single financial decision you make with your dollar is either building an asset or it's building a liability. So how do we actually make sure our dollars are building assets? Well, we need a plan. And the 50-30-20 budgeting rule is a fantastic baseline for this. It basically divides your take-home pay into 3 distinct buckets. 50% goes to your fundamental needs: rent, groceries, the absolute essentials. 30% is for fun spending. Dining out, hobbies, actually enjoying life today. But look closely at that final 20%. That is dedicated strictly to future you. That 20% is the portion of your dollars that you must aggressively protect. It's what you use to save, invest, and ultimately buy back your time and financial freedom.
Moving on to Section 2, escaping the debt trap.
Before you can even think about building wealth, you've got to rescue your dollar from bad, high-interest debt. This stuff literally drains you faster than you can build it. We're talking about anything with an interest rate over 8%. Credit cards, payday loans, the whole shebang. If your dollar is caught in this trap, there are basically 2 main escape routes. The debt avalanche method is mathematically the most efficient. You rank and pay off your debts from the highest interest rate down to the lowest, which saves you the most money over time. But let's be real, humans aren't just calculators, right? We need motivation. That's where the debt snowball comes in. You just ignore the interest rates entirely and pay off the smallest balance first. It gives you a quick emotional win to build momentum. The data actually shows that the absolute best method is simply the one you'll stick to. Honestly, either one is vastly better than doing nothing.
All right, Section 3, deploying your first dollar.
Now, what's really interesting about this slide is what happens once you've secured your emergency savings and escaped that high-interest debt. It's time to actively put your money to work in the market. The most common vehicle for this is a stock. Now, it's vital to remember that a stock isn't just some flashing red or green ticker symbol on a screen. It is quite literally a share of ownership in a real, breathing company. It gives you, the shareholder, a claim on a portion of that company's earnings and assets. You make money through price appreciation, when the stock's value goes up, and often through dividends, which are just direct payouts of the company's profits right into your pocket.
But here's the catch. Picking individual winning stocks is incredibly difficult, even for the pros. That's exactly why experts widely recommend index funds. An index fund is just a passively managed fund that simply copies a list of companies, like the S&P 500, which tracks the 500 largest companies in the US. Because you don't have some expensive Wall Street manager actively picking and choosing the stocks, the fees are incredibly low. We're talking often between just 0.02 and 0.20%. By dropping your dollar into an index fund, you instantly spread your risk across hundreds of companies. So if one company completely fails, it's not going to tank your entire investment.
And to put that into perspective, this slide brilliantly illustrates the staggering power of time. Historically speaking, over the last 100 years, anyone who invested in the S&P 500 and just left it alone for a minimum of 20 years never lost money. Let me say that again, because it's wild. 0 times in a 20-year stretch did the market deliver a negative return. If you invested $100,000 and hit a 10% average historical return, over 20 years it would compound into roughly $670,000. That is the incredible silent power of long-term compounding.
Which brings us to Section 4, the algorithmic edge.
So we've seen what your dollar can do over decades, but Wall Street, they deploy dollars a little differently. Welcome to the world of quant trading. This is basically a catch-all term for using systematic mathematical models, AI, and algorithms to execute trades or even find startups to invest in. And it is far from just some guy banging on a keyboard in a basement. It's a highly elite team sport. It requires quantitative researchers hunting for new revenue streams, what they call alpha, working right alongside traders managing risk, and developers building the insane infrastructure that executes these strategies in real time.
To get that edge and find market outliers faster than any human possibly could, these quant funds use massive, non-traditional data sets. They call this alternative data. AI algorithms are literally out there right now scraping open-source GitHub repositories to see what code developers are building. They're ingesting live Shopify financial data via APIs. Some funds even hunt down proprietary credit card payment data to instantly see where consumers are spending their cash. They are constantly analyzing the digital footprint of the whole world to make their dollars multiply before the general public even has a clue what's happening.
Let's move to Section 5 and see how this builds. Surviving financial collapses.
Okay, things take a darker turn here. What happens to your perfectly budgeted, brilliantly invested dollar when the very structural foundation of the financial system just gives way? Well, history impartially shows us that total financial crashes rarely happen overnight like a lightning strike. Instead, they follow these really prolonged buildups of imbalance. The final stage right before a crash is defined by managed illusions. This is that perilous moment when the promises inside a system, like a bank promising your deposits are totally safe or a government saying a currency is stable, become way larger than the actual real cash flows supporting them. Leaders use delay tactics to mask the rot in the floorboards, while everyday people continue trusting a structure that's already fundamentally broken.
And we see this exact same pattern cascade globally throughout history. In 1997, Thailand was forced to devalue the baht because they couldn't artificially peg it to the US dollar anymore. That wiped out local businesses and triggered the Asian financial crisis. In 2001, to hide a failing system, Argentina imposed the Corralito, a really harsh legal freeze on bank withdrawals that just trapped the life savings of regular citizens. And of course, in 2008, the US financial system imploded when rising home prices couldn't mask the massive rot of bad subprime mortgages anymore. The flags and the languages change, but the pattern of over-leveraged debt and managed illusion, it is exactly the same.
So, what do the survivors of these historic collapses actually do differently to protect their wealth? The historical record points to three very clear strategies. First, maintain liquidity. You need access to money you can actually use immediately, because ownership on paper isn't always the same as access in reality. Second, avoid concentration. Never stand entirely on a single thin pillar. You've got to spread your exposure across different asset classes, different banks, maybe even different currencies. And third, stay adaptable. The absolute most resilient asset you have is your own ability to generate value. Cultivating productive skills that are tied directly to the real economy will outlast any bank freeze.
And that brings us to a pretty harsh historical truth. When the system breaks, it doesn't destroy evenly. It redistributes. As the quote says, "The careful citizen who follows every rule is often the one standing still when the floor opens." In past collapses, it was often the middle-class savers who blindly trusted the local bank or a failing currency peg that were devastated. Meanwhile, the people who understood the machinery, stayed flexible, and actually read the calm warnings accurately, they were able to shield their funds. It's a stark reminder that blind trust in financial stability is a massive, massive risk.
And that brings our dollar's journey to a close. We've seen how to budget it, how to rescue it from debt, how to grow it in the markets, and the ultimate historical lessons on how to keep it safe when systems fail. So, I'm going to leave you with this final, vital question. If the financial system cracked tomorrow, is your dollar truly prepared to survive? Think about your own balance sheet, your own safety nets, and your overall strategy. Thank you so much for joining me on this explainer. Keep learning, stay adaptable, and I will see you next time.